Between July 17th and July 23rd, Bitcoin's price action appears highly erratic. The chart is defined by sharp wicks reaching towards $67,000, followed by a series of volatile grinds back down into the $65,000 range. It is common to assume that this localized volatility stems from shifting retail sentiment or is a reaction to major fundamental news events. However, in markets dominated by derivatives, short-term price discovery is often a function of liquidity routing rather than external news. To identify the drivers of these moves, we must look past historical candlesticks and map the mandatory unexecuted order flow sitting in the book. This specific type of volatility reflects a mechanical process where market makers systematically extract liquidity from established leverage clusters. The CoinGlass liquidation heat map visualizes this hidden dimension. On the z-axis, color intensity represents the density of leveraged positions. As bands shift to yellow, they indicate traders nearing margin calls. These bands act as attractors, drawing price toward forced orders. In this context, price acts as a heat-seeking missile, moving specifically to target and trigger these off-chart liquidation zones. Without mapping these pools of forced orders, modeling short-term cryptocurrency direction becomes significantly more difficult. On July 20th, Bitcoin consolidated between 64,000 and 66,000. This sideways chop encourages participants to increase leverage to maintain yield. This accumulates massive short seller stop-loss orders, visible here as a thickening yellow band just above 66,000. By 1600, the density of these leverage zones had solidified, with two distinct high-intensity pools forming above and below the current price. As the sideways trend continued through the evening, these liquidation bands remained perfectly intact, creating the conditions for a liquidity sweep. Market consolidation is frequently the period where the liquidation spring is mechanically loaded. On July 21st, price began testing the 66,000 level, moving directly against the horizontal yellow bands we identified earlier. As price reaches the boundary of a liquidation cluster, the order book dynamics shift to favor the consumption of those forced orders. At 8 a.m., price broke 66,000, heading directly for the dense liquidity band at 67,000. Touching this band initiates a feedback loop. The initial liquidations trigger a cascade of forced market buy orders, accelerating the price move into the next level of stops. Algorithmic market makers utilize this concentrated surge of forced buying to fill their own limit sell orders with minimal slippage. Once price crosses 67,000, the previous pool of short liquidity is neutralized, leaving the space above the price cleared on the heat map. Breakouts of this nature often function as targeted algorithmic sweeps designed to access these clusters of mandatory liquidity. Following the upward move, the market bias often shifts as retail traders enter long positions in anticipation of further breakout momentum. By 8 p.m. that same day, this behavior generated a new, dense liquidation band below the price, centered just under 66,500. With the upper liquidity consumed, routing protocols often pivot to target this fresh pool of forced selling. By the morning of July 22nd, price began a systematic move downward, hunting the newly established long leverage. The downward wicks show a high degree of precision, penetrating the top of the yellow band at 65,500 before the move exhausted. The descent continued into July 23rd, with price resting directly on the leverage-based support at 65,500. These reversals can be identified as a sequence of symmetrical liquidity extractions, where price moves to reach the next available pool of forced orders. A comparison between the long squeeze of July 17th and the short squeeze of July 21st reveals a symmetrical pattern in how liquidity is accessed. The algorithms driving these market makers operate without directional bias. Their primary objective is efficient liquidity access, regardless of whether the price is moving up or down. This is evident in the price paths, which terminate with precision inside the highest intensity leverage nodes. In consolidating environments, algorithmic routing targets over-leveraged positions on both sides of the market with a high degree of efficiency. Liquidity heat maps map the topography of mandatory market orders rather than organic support or resistance. When leverage clusters at obvious technical levels, it creates the specific conditions that these algorithms are designed to exploit. In these environments, traditioning chart patterns function as secondary indicators, documenting the path taken to reach these primary liquidity zones. For the quantitative professional, Integrating off-chart leverage data provides a more complete map of the forces driving short-term volatility. The swings observed during this week illustrate how price movement can serve as an orderly tool for the mechanical extraction of over-leveraged capital.